All right, in today's video, we're going to look at the 2 questions you need to ask in order to determine which company that you're going to invest in. And then we're going to look at 3 companies that I particularly chose using those very questions, and we'll see the end results of how that turned out. Question number 1 is, do you understand the company? Do you know what it makes, and do you know how it makes money? And we'll talk about an example of that here in a minute. Okay, question number 2 is, do you believe that this company is going to be around for the long term? Is it going to be there when you finish and you retire? Will it stick around for 30 to 50 years? And in order to answer that question, we have to ask 3 other questions. The first of those questions is this a company that innovates? Is it a company that is putting a lot of money and time into research and development so that it does not become irrelevant? Question number 2 is, does it have any really major competitors that could come and wipe it out? A good example of this is Blockbuster, which back in the day, in the 90s and early 2000s, was the dominant rental company for video, and that's how everybody got their movies. And then along came Netflix and just destroyed them, and now they're pretty much toast. They're gone. The third question is this a new segment of the market, kind of a new untapped area, and they're the first ones to show up? And in those kind of scenarios, frequently the first one who shows up isn't necessarily the winner. And so it creates kind of a higher probability that they can be taken out. And a perfect example of this is when social media really started getting kicked off. It was with MySpace. And then along came Facebook and kind of wiped out MySpace. So ask those 3 questions. Does it innovate? Does it have any kind of major competitors? And is it so new to the market that there's a high probability of risk that it's going to be taken out by somebody else? Even though those are the 2 major questions to ask, one other thing to consider when you're looking at a company is if in that particular moment the price is hyperinflated, which can happen. And sometimes that's how you're hearing about it, because everyone's like, hey, you need to buy Tesla. And there was a moment when everybody was saying buy Tesla, and it was in this massive bubble. And one way you can kind of figure out whether or not a company is worth, or I'm sorry, if a company is hyperinflated in price, is to look at something called the PE ratio, price to earnings ratio. And essentially, if I had to break it down as simple as possible, it's however much money that company made in a particular year, how much, if you took that money that it made for the year, how many years it would take to pay back all its investors at that current stock price. And it used to be that a standard solid PE ratio was around 15, so like 15 years. The stock market in general over the last decade plus has moved higher and higher on average, so that now kind of the new norm is 30, which is scary, which means that maybe at some point it'll correct back down to a lower number. But right now, 30-ish seems to be a doable number. It's really hard to find anything down at the 15-year mark. But I purchased Tesla myself years ago because I believed in it. It had all the things that I really liked about a company, research and development. It seemed like they were doing really good and getting a good grab on the market. And then the price just kept going up and up and up. And at first I was excited, but when the PE ratio hit over 300, which means at its current value of what it's producing every year, it would take over 300 years to pay back all those stocks. To me, that was insanity. And so I almost always hold on to my stocks for the long term, except in this case, I'm like, I don't believe it's worth this amount. This is nuts. And so I sold, and I sold it at 11 times what I bought the stock at. So I made a good amount of money on it, and it did come down afterwards. And who knows, maybe it'll go up again. Maybe it'll go past that price that I purchased it at. I don't know, but I felt safer in the fundamentals of a solid company, and that made it unstable and not solid for me. So I got out. All right, so using those questions, we're now going to look at specific companies that I chose and apply those questions to them and why I chose them. And the very first company that we're going to look at is Microsoft. And Microsoft is easy. You know what it is. It's a very easy to understand company that satisfies our first one. We know what it makes. It makes things like Xbox Live and the Xbox, but more importantly, it has an operating program, Windows, which is used absolutely everywhere. And it has the Microsoft Office suite, which is used by companies all over the place. And it continues to expand and grow. So there's a lot of growth potential here for this company as more and more of the world comes online. And this company actually puts a lot of money into research and development to look for the next thing that they want to do and to make sure that their programs continue to stay relevant and continue to move forward. So by doing so, they are satisfying all those questions that we want. They're innovating. They don't have any major competitors. They absolutely dominate the market, as I mentioned. And it's very easy to understand the product that they're selling. So then the question to ask is there price that they're currently asking, is it a good one? And last time I checked, the price earnings ratio was about 37, which in today's terms is decent. That works. The particular results that I had, the latest year that I had them, the price went up by 76%. And keep in mind that the stock market on average, the whole market itself, on average over time usually goes up by 8 to 12%. So 76% is crazy to have that kind of increase. And this is not some sort of crazy stock hype bubble. This is just a solid company moving up. And I can't guarantee, of course, that it'll do that every single year, but it does tend to move up at a pretty good pace. And then if I look at a 2-year period of time versus 1 year, it's gone up by 152%, which means it's, of course, it's more than doubled its money in a 2-year period. So it's been a very solid return for my investment. And it's a simple stock like Microsoft. All right, the second company that we're going to look at that I picked is Walmart. And everybody knows who Walmart is. In fact, 90% of Americans live within 15 minutes of a Walmart, so they're absolutely everywhere. And yet they still continue to grow. And that is because they're starting to move into other parts of the globe and take on more and more of a presence there. So there's still plenty of room for growth. It's very easy to answer the question of, do you understand what they do? Yes, they sell food and household products at inexpensive prices. That's their model. And they do that absolutely everywhere. So they have plenty of collateral as well to kind of, make sure that what you're buying is actually worth something when you buy their stock. The other part too is that they are innovating. They are a company that has put a lot of time and money into growing their online retail presence. And so they have a great opportunity to take over more and more of the Amazon pie, to take that away from them. In fact, there's some predictions I've read that because of their infrastructure, all the stores that they have, there's actually a possibility they could maybe even one day meet or exceed what Amazon is doing. So for me, that's a solid fundamental moving forward. The price earnings ratio, the last time I checked, was around 41, which again, it's an okay amount. And the last year that I had them of returns was about 32% for the last year. Lower than what I got with Microsoft, but still a very respectable return when, again, you're looking at the stock market normally going up from 8 to 12%. 32% is good. And then I've held them for quite a long period of time. I've had them for 6 years now. And over those 6 years, they've gone up by 192%. So they've almost doubled the amount that I initially invested in, and it's a solid company. Walmart, for me, is my second pick. Okay, third and final company that we're looking at is Google. And of course, Google is the search engine that's used not only here in America, but all over the globe. And what they sell is very easy to understand, and how they make money. They make money by people use their search engine, and then they have targeted ads based on whatever you're searching come back. And that provides their income, and they do a good job of that. But what really drew me to Google initially was the fact that they probably have a larger percentage of their revenue go back towards research and development than almost any other company out there. And that to me is very exciting. I love anybody who's really putting time and money into trying to figure out what's next. And Google does it in a particular amazing fashion. Now, most of it's going to just regular research and development, but they're, of course, the ones who have the Moonshot program, which is only a small part of their research and development project, money, I'm sorry. But this is the one where if they invest in something, they understand that 99 of these potential things that they're working on are probably not going to work out. But the idea is that if even one of them can pan out, of these crazy ideas that they come up with in the research and development, it could revolutionize the world. And so I just like that idea. I think that's cool. I like that innovation, which means that even if they're doing good now, there's a good chance they can come up with something even more amazing down the road that we don't even know about. So I love that. Their PE ratio is 28, so lower than the previous two. And I've been with them for quite some time, but the last year that I've had it, the stock has gone up by about 61%. And over a 5-year period, it's gone up 308%, which means if I were to take $100, at the end of the year, it'd be $161. But if I would have had it there for 5 years, which I have, $100 would be now, $408? Am I doing the math right? Anyway, so yes, a solid investment, one I've been very happy to have and see grow over time, and it feels still like a good price and a solid company. All right, so that's our video on how to pick individual stock, the process to put in place. 3 stocks that we just talked about right here are all still good buys right now. So if you're curious and you don't really know which ones to go for, not the worst in the world to pick. Understand, of course, that any stock at any point could go down. Past performance is not an indication of future performance. So because it's done well for me doesn't necessarily mean it's going to continue to do well. However, I do believe that the fundamentals that I just discussed are still in place for all three of these companies, and there's no reason why it shouldn't thrive in the long term. Don't get mad if you buy it and the price goes down the next day. That's just the way the stock market works. But if you do hold on to it for the long term, I think it's a pretty good bet that it's going